The euro, it was supposed to be beautiful, a single currency for a united Europe. From Lisbon to Helsinki, one money to bind them, to bring prosperity. Open borders, free trade, shared dreams of a brighter future. The euro was the symbol of this ambition, launched in 1999 with promises of stability and growth. For a while, it seemed to work. The Eurozone thrived, economies grew, people felt closer, more connected. But beneath the surface, cracks were appearing. Some countries like Greece were living beyond their means. They masked their true financial situations with creative accounting. Debt piled up, hidden from view like a family's embarrassing secret stashed in the attic. The good times couldn't last forever. The 2008 financial crisis hit the world hard. Banks teetered, economies shuddered, and suddenly that hidden debt in Europe, it wasn't so hidden anymore. The crisis exposed the weaknesses of the Eurozone, the flaws in its design. The dream of unity was about to be tested. 2009, the year everything changed. Greece, once a symbol of ancient glory, became synonymous with financial turmoil. The new government dropped a bombshell. Greece's budget deficit was way higher than anyone imagined. It was a staggering 12.7% of its GDP, not the 3.7% previously claimed. The news sent shockwaves through the global markets. Panic spread like wildfire. Investors, once eager to lend to Greece, slammed on the brakes. They feared that the country wouldn't be able to repay its debts. The cost of borrowing for Greece skyrocketed. Interest rates soared. Suddenly, Greece was on the brink of default, facing financial ruin. The situation in Greece was dire, but it wasn't an isolated incident. Other Eurozone countries like Portugal, Ireland, Italy and Spain were also struggling with high debt and sluggish economies. The crisis was spreading, threatening to unravel the entire Euro project. The dream of unity was facing its biggest test yet. To avoid a complete meltdown, the European Union, the International Monetary Fund and the European Central Bank stepped in. They offered Greece a lifeline, a massive bailout package worth billions of euros. But this lifeline came with strings attached, and those strings were tied tight. Austerity. That was the bitter pill Greece was forced to swallow. Cut spending, raise taxes, slash pensions. These were the demands of the Troika, the trio of institutions overseeing the bailout. The goal was to get Greece's finances in order, but the human cost was immense. Public services were slashed, unemployment soared, especially among young people. Pensions, once a source of security for the elderly, were cut dramatically. People lost their jobs, their homes, their hope. Resentment towards the Troika grew. Protests erupted on the streets of Athens, Madrid, Lisbon. The people were hurting and they wanted their voices to be heard. The European sovereign debt crisis was a tumultuous period. It tested the very foundations of the European project. The crisis exposed the flaws in the Eurozone's design, the lack of fiscal integration, and the political tensions between member states. But it also revealed something else, the resilience of the European Union. Despite the challenges, the Eurozone held together. The bailouts, though controversial, prevented a complete collapse. Austerity measures, while painful, helped to stabilize economies. By 2014, the Eurozone was on the road to recovery. The crisis had been averted, but not without leaving scars. The European sovereign debt crisis was a stark reminder of the importance of unity and solidarity. It showed that a shared currency requires shared responsibility, fiscal discipline, and a willingness to work together in times of crisis. The Eurozone emerged from the crisis stronger, more integrated, and with a deeper understanding of the challenges and opportunities that lie ahead. The dream of a united Europe, though tested, remained alive.